Okay, so picture this. You've done everything right. You opened that investment account. Maybe it was a Tuesday. Maybe you were feeling particularly motivated after watching some finance video at midnight. And you put in your money. You set up the automatic transfers. You told yourself, this is it. This is the move. This is how I start actually building something real. And then you check it 3 months later. And it's gone up like $40. $40? And I know that feeling. I know that specific brand of disappointment where you're not even really mad, you're just deflated. Because you did the thing. You did what everyone told you to do. You invested early, you stayed consistent, you didn't panic sell when the market dipped, and your reward is $40 and a mildly interesting pie chart. And here's where most people make a decision that quietly costs them everything. They look at that number, they do some rough math in their head, they think about how long it's going to take to actually get somewhere meaningful, and they go, you know what? Maybe I'll just not. Maybe I'll use this money for something I can actually see and feel and enjoy right now. Maybe compounding is something that works for other people, richer people, people who started earlier, people who aren't me. My name is Emmy, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others, people who are equally smart, equally hardworking, equally deserving, stay stuck in the same financial place for years, even decades, wondering what they're missing. And what I've found after going deep into this stuff is that the thing most people are missing isn't a higher income or a secret investment strategy or some insider information. It's something much simpler and honestly much more frustrating to hear. It's understanding. Specifically, understanding what compounding actually looks like across time. Not the version from the textbook, but the real version. The version that explains why it feels brutally slow at first, and why that slowness is actually the whole point. Today, I want to talk to you about something called the 8-4-3 rule. And I know, another rule, another framework, another thing to remember. But stay with me, because this one is different. This one doesn't tell you what to do. It tells you what's already happening. And once you see it, you cannot unsee it. And more importantly, it might be the thing that stops you from giving up right before the moment everything changes. Section 1. Why compounding feels like a scam at first. Let's just be honest about something that finance people don't say enough. Compounding in the early years genuinely does feel like a scam. You read about it and it sounds incredible. The eighth wonder of the world, they say. Einstein may or may not have actually said that, by the way. That quote is very loosely attributed. But anyway, and you think, yes, my money makes money, and then that money makes more money. And eventually I'm just sitting on a beach somewhere while wealth accumulates around me like sand. And then you start, and it's nothing. It's nearly nothing for a really long time. The reason for this is mathematical, and it's also deeply psychological, and understanding both parts is important. The math part is this. Compounding is exponential growth, and exponential growth is famously terrible at being impressive early on. The first few doublings of anything, small, just produce something slightly less small. Let me give you a really simple example. Imagine you start with $10,000 and you're earning 10% a year, which is roughly the historical average of the stock market, give or take. In year 1, you make $1,000. Okay, cool. Year 2, you make $1,100. Year 3, $1,210. After 3 years of doing everything right, you have made somewhere around $3,300 in gains on $10,000 over 3 years. Yeah, you can see why people walk away. But here's the thing that's actually happening underneath those numbers, the thing the 8-4-3 rule is going to make viscerally clear to you. The percentage gain is the same every year. What's changing is the base it's being applied to. And in the beginning, the base is small, but the base is growing, quietly, invisibly, building up pressure the way water does behind a dam. The problem isn't that compounding is slow. The problem is that we're measuring it wrong. We're looking at dollar amounts when we should be watching the structure that's forming underneath. Okay, so let's actually talk about this rule, because I think it's one of the most elegant ways to understand compounding that I've ever come across, and honestly, I'm a little frustrated it doesn't get talked about more. The 843 rule, and I want to be clear, this isn't some ancient law of finance, it's more of a useful observation, a framework that came out of analyzing long-term investment trajectories. Goes like this. If you're investing consistently and earning a reasonable market return, roughly 12% annually, which is aggressive but not unrealistic for equity markets over long periods, depending on your portfolio, here's what happens. It takes you approximately 8 years to double your money for the first time. Then it takes 4 more years to double it again. And then, and this is the part that should genuinely stop you in your tracks, it takes just 3 more years to double it a third time. 8 years, then 4, then 3. The same doubling, dramatically less time each round. Now, why? Why does the same outcome take half the time the second round and even less time the third? The answer is the base. Every time your money doubles, the new base is twice as large, which means the absolute dollar amount being generated by that same percentage return is twice as large, which means you cover the distance faster. It's the same engine, same fuel, same road, but the car has gotten dramatically heavier in the best way possible, and that weight is carrying you forward. Let me make this concrete, because I think abstract explanations of compounding are part of the reason people don't feel it emotionally. Let's say you start with $20,000 at age 25. We're using 12% annual return. Optimistic, sure, but let's use it for the illustration. By age 33, 8 years in, you have roughly $40,000. You've doubled. And honestly, you probably feel underwhelmed, because $40,000, while not nothing, doesn't feel like life-changing money. It doesn't feel like the payoff for 8 years of discipline and patience. But then, 4 years later, at 37, you have $80,000. The same doubling happened in half the time. And then 3 years after that, you're 40 years old, you have $160,000. And 3 more then, $320,000. You're in your mid-40s and you haven't added a single dollar beyond that original $20,000, which obviously in reality you would be adding more along the way, and you are approaching $1 million. The first 8 years gave you $20,000 in gains. The last 3-year period we looked at gave you over $300,000 in gains. Same percentage, same investment, completely different world. That is the 843 rule, and that's why the early years aren't wasted, they're load-bearing. Here's a metaphor I keep coming back to. Compounding is like being in a waiting room where you don't know how long the wait is going to be, and the longer you sit there, the more you start to wonder if you're in the right place, if this is worth it, if you should just leave and do something else with your afternoon. And most people leave. That's honestly the data. Most people somewhere in that first phase, those 8 years that feel like they're producing almost nothing visible, make a quiet decision to redirect their resources. They cash out a portion. They pause contributions. They convince themselves they'll restart later when things are more stable, when they have more to invest, when it makes more sense. But here's the brutal truth about leaving the waiting room. The wait resets. Not exactly, not in a perfectly mathematical way, but in a real practical sense, because the years you spent building that base were the years that were going to compress all that future growth. You can't get them back. You can add money later, yes, you can invest more aggressively later, but you cannot go back and give compound interest more time to work on those early dollars. Time is the one input in this equation you genuinely cannot buy. And I think that's what makes early compounding so psychologically difficult, because we live in a world that's absolutely saturated with immediate feedback. You post something and you see the likes in real time. You make a purchase and it arrives tomorrow. You want a result and there's usually a pathway to getting it relatively quickly. But compounding operates on a completely different timeline. It asks you to do something that our brains find genuinely uncomfortable. It requires you to act against your immediate instincts in service of a future self who will genuinely be grateful, but who feels very abstract right now. That's not a character flaw, that's just being human, but knowing it's a feature and not a bug means you can design around it. Now, everything I've described so far is based on a lump sum. You put in money once and you let it ride. But most of us aren't doing that. Most of us are investing a little bit at a time, month by month, paycheck by paycheck. And the 8-4-3 rule interacts with regular contributions in a way that's even more powerful, and also, honestly, a little more complicated to visualize. Here's the simplified version. Every dollar you contribute is starting its own compounding journey from the day it enters the account. Your contribution from 5 years ago is 5 years into its exponential curve. Your contribution from last month is just getting started. What you're building isn't one compound curve, it's thousands of overlapping compound curves, each at a different stage, each accelerating at its own pace. This is why the total in your account can start to feel like it's moving faster after several years of consistent investing. It's not just that your oldest money is compounding faster, it's that you've accumulated so many different streams of compounding that they're all pushing the total number upward simultaneously. The math starts to feel like it's working in your favor in a way it really wasn't in year 1 or 2. Let me put some numbers to this because I think it helps. Let's say you invest $500 a month starting at 25, and you earn 10% annually, more conservative than our earlier example. By 35, 10 years in, you have a little over $100,000, which is genuinely real money, but you've contributed $60,000 of that yourself. The market has given you about $40,000 in gains. Fast forward to 45, you have around $340,000. You've contributed $60,000 more, total contributions of $120,000. But the market gains? About $220,000. The market is now contributing more than you are. The math has shifted. By 55, close to $900,000. You've put in $180,000 of your own money across 30 years. The market has generated over $700,000. You are, at this point, basically a passenger, a very patient, very vindicated passenger. That's what the contribution layer does. It keeps feeding the engine during the years when the engine is still small. And then one day you realize the engine is enormous and you've been feeding it this whole time without fully seeing what you were building. Section 5, the mental shift, learning to measure differently. Because I think one of the biggest reasons people abandon their investment journey prematurely is that they're using the wrong ruler. Most people measure wealth-building progress in dollars, which makes sense. Dollars are tangible, dollars pay rent, dollars feel real. But in the compounding phase, measuring in dollars is a bit like measuring a tree's growth by how much shade it casts. In the first few years, barely any shade, but the root system? Expanding dramatically below the surface, invisible, building the infrastructure that will eventually let the tree grow 50 feet tall. A better way to measure, and I'll be honest, this takes practice, is to measure in time. Specifically, to look at your portfolio and ask not how much have I made, but how many future doublings have I secured. Every dollar in your account right now isn't just a dollar. It's a dollar that, given enough time and a reasonable return, will double and double again and again. At 12% returns, money doubles roughly every 6 years. So a dollar invested today at age 25 becomes $2 by 31, $4 by 37, $8 by 43, $16 by 49, and so on. That $1 left untouched for 40 years becomes over $64 just from sitting there. So when you look at your account and you see, say, $30,000 and you feel underwhelmed, try to see it differently. Try to see $30,000 in their various stages of doubling. The earliest dollars, the ones you invested years ago, are already well into their journey. The more recent ones are just starting. Together, they represent a future number that is significantly larger than 30,000. You just can't see it yet because it hasn't happened yet. This is what I mean when I say we have to learn to see differently. The account balance is the least interesting number. The most interesting number is what that balance becomes with time, and that number is invisible unless you train yourself to imagine it. Okay, so I want to flag something that I think is genuinely underappreciated, which is that there's a specific window, roughly years 3 through 7 of any investment journey, that I think of as the danger years. Not because anything bad is happening, but because everything is happening slowly enough that quitting feels completely rational. In year 1, you're new to this, you're motivated, the account is young and you're excited and you're checking it too often, and even small gains feel meaningful because you're in the honeymoon phase. By year 2 or 3, the novelty has worn off. You're not new anymore. The account has grown, but not in a way that changes your life. And now you're also running into life expenses. Maybe you're thinking about a house, or you had a kid, or your car needed a major repair, or honestly, you just want to travel somewhere and you need to find the money. And that investment account is sitting there, looking like money, which it technically is. And the math in your head goes, I've been doing this for 3 years and I have basically the same amount I put in, with gains I can barely feel. Maybe I should just cash this out, use it for something real, and restart later when things are more stable. I cannot stress enough how many investment journeys end in exactly this moment. And I get it. The logic feels sound. You're not being irresponsible, you're being practical. You have real needs. The future is uncertain. But here's what's actually happening in that moment. You're pulling the plug right before the trajectory starts to visibly shift. You're in the last days before the waiting room door opens. And you won't know that because the future is invisible. You'll just know that today the account feels like it hasn't done much, and today you have real needs. There's no easy answer to this tension. Sometimes you genuinely do need to access those funds. Life is real and it doesn't pause for optimal financial planning. But if there is any possible way, any way at all, to find the money somewhere else and leave the investment account alone, that is almost always the right call. Not because the account is sacred, but because the years you're in right now are the years that make everything else possible. If you're in this window right now, I just want you to hear this. The math is working. You just can't see it yet. Don't leave the waiting room. Here's a tangent I want to take, briefly, and bear with me because I think it actually reinforces the financial point. The 8-4-3 principle isn't just about money. It's a description of how any compounding system works. And once you see it in investing, you start to see it everywhere. Skills compound. The first few years you're learning something, whether that's coding or writing or a foreign language or a musical instrument, feel brutally slow. You're putting in enormous effort for tiny visible gains, and then at some point, the base of your knowledge becomes large enough that every new thing you learn connects to 10 things you already know, and suddenly you're improving fast. Not because you changed anything, but because you built enough foundation for the growth to accelerate. Relationships compound. The early years of a friendship or a marriage or a professional relationship are the investment phase. You're putting in effort and trust and time, and the returns feel modest. But a relationship that survived 15 years of real life has a base of shared experience and trust so large that it can weather almost anything. The compounding shows up as resilience, as depth, as the feeling of being genuinely known by another person. Reputation compounds. The first several years of showing up consistently, doing good work, being reliable, largely invisible. And then suddenly, you're the person everyone recommends, and opportunities come to you faster than you can handle them, and it feels like it happened quickly, but it didn't. It was just the 8-4-3 pattern doing its thing. I'm not trying to be mystical about this. I'm just saying that understanding compounding as a pattern, not just as a financial concept, might help you be patient with it in the financial domain, because you've already seen it work. You've already experienced it in some part of your life without necessarily calling it by this name. The compound curve is not a financial theory. It's a description of how growth actually works. All right, let's bring this somewhere useful because I don't want you to walk away from this having had an interesting intellectual experience, but no idea what to actually do with it. First thing, if you're not invested yet, the most important thing you can do is start. Not optimize, not research the perfect portfolio allocation, not wait for a market dip or a better moment or a higher income. Start. A simple, low-cost index fund, something that tracks a broad market index, opened today and funded with whatever you can realistically contribute right now, is better than a perfectly optimized portfolio that you start in 3 years after you feel more ready. Every month you delay is a month of compounding you cannot reclaim, and the 8-4-3 rule tells you very clearly that the early months, painful as they are some of the most structurally important months in your entire financial life. Second, automate everything you possibly can. The danger years I talked about, years 3 through 7, are dangerous precisely because they require active, ongoing decisions to stay invested. Automation removes those decisions. If the money transfers automatically before you see it in your checking account, you never have to make the choice to invest it. It just happens, and that removes the point of failure that ends most investment journeys prematurely. Third, change the way you check your account. This sounds minor, but I think it's genuinely significant. Most people check their balance and feel a vague mixture of emotions: hope, disappointment, uncertainty, and then close the app. Instead, I'd encourage you to look at the balance and do a quick mental exercise. Double it. That's approximately where you'll be in 6 to 8 years. Double it again. That's 12 to 16 years out. Do it a third time. 4 to 5 times the current balance represents roughly your mid to late career wealth if you stay consistent. Does that number feel different than the one on the screen? It should, because that's the real number. The screen is just showing you the current snapshot. Fourth, protect your contributions during life transitions. Major life events, moving, job changes, having children, health issues, are the moments when investment contributions get quietly paused and then never restarted. Build a mental firewall around your investment contributions. Treat them like a bill, not a choice. Bills don't get skipped because life is busy. Your future self's financial security shouldn't either. And fifth, and this is probably the most important thing I can say, find some way to make this feel real. The psychology of compounding is deeply about temporal distance, about a future that feels abstract. Anything you can do to make that future feel concrete and real will help you stay motivated. Name a number, give it a year, write down what you're building toward, put it somewhere you'll see it. The abstract future needs to become a specific, emotionally real destination. Otherwise, it will always lose to the concrete present. So let me bring this all together for you, because I've thrown a lot at you, and I want to make sure you leave with the thing that actually matters. The 8-4-3 rule is at its core a description of patience, not patience as a virtue, not the kind of patience that's just gritting your teeth and waiting, but patience as a form of intelligence. The understanding that the early period is not the failure period, it's the foundation period. And foundations don't announce themselves, they just hold weight quietly for everything that comes after. The reason compounding feels slow is not that it is slow, it's that we're measuring the wrong thing at the wrong time. We're looking for visible results during a phase that's fundamentally about invisible accumulation. The real growth is happening underneath, in the structure, in the base that keeps expanding, and it will express itself eventually, dramatically, in ways that will feel almost unfair in how sudden they seem. 8 years to the first doubling, 4 to the second, 3 to the third, and then it just keeps accelerating. The math is not complicated. The instruments are not complicated. The only complicated part is being human while all of this is happening. Being human means wanting to see results now, wanting the reward to match the effort in real time, wanting $40 to feel like the beginning of something, not an insult. But here's what I know, and what I hope you carry out of this conversation with you. The people who build real wealth over the course of a lifetime are not, for the most part, smarter than you or more financially sophisticated than you. They are simply people who found a way, somehow, whether through understanding or discipline or habit or stubbornness, to stay in the waiting room. That's it. That's the whole thing. Stay in the waiting room. The door is coming. The numbers are working. The curve is bending even when you can't see it. And the version of you on the other side of those 8 years, the one looking back at this moment, at this decision, at this particular Tuesday or Thursday when you were watching a video about compounding and wondering if it was really worth it, that version of you will know with complete certainty that it was. You're not late. You're not too small. You're not missing some secret the wealthy know. You're just early in a game that rewards staying in it more than almost anything else. So stay. If something in this video landed for you, if there was a moment where something clicked, I'd genuinely love to know what it was. Drop it in the comments. And if you've got a friend who's been thinking about starting to invest but keeps putting it off, send this to them, not with pressure, just as a nudge. Sometimes the right explanation at the right moment is all someone needs. Take care of yourselves. I'll see you in the next one.